they've been realistic about the pain that they're actually going to cause. If you look at their forecast last week, the unemployment rate climbs a little bit. It climbs up to 4.4%, and then inflation melts away. I don't think it's going to be quite so simple as that.
That was the former New York Fed President, Mr. Bill Dudley there, weighing in on Bloomberg Surveillance a little bit earlier. We are going to get a ton of Fed speak this week and a sprinkle of economic data. Taylor Riggs has more. Hey, Taylor.
John, and you're right with that big Bloomberg opinion column coming out saying that really the Fed is sort of underplaying or underestimating the pain that's really going to be coming when you think about this inflation targeting regime and then what happens on the economic side as well for that. So can we continue to out-hawk ourselves and we get all of this Fed speak coming up? You also did hear from Charlie Evans, of course, overnight as well, saying that 4.5% unemployment would be okay. That would be a good outcome. So again, a focus on inflation and a focus here on the world of economics. Take a look at real yields. We spoke with Subhadra Rajappa at SocGen, of course, yesterday, John, highlighting the rate of change in nominal yields, but the rate of change in real yields as we've really come off the depths of the lows of negative real yields. And as you can see, they're firmly into positive real yield territory, the tightening of the financial conditions that this chart represents. Finally, if you just want to think about the death of the 60-40 portfolio year to date, the worst we've had since 2008, it is all dollar strength. It's bond lower, equities lower as well, but cash and dollars good.
Brutal, brutal. And everyone seems to love dollar cash right now. Taylor, thank you. Just absolutely awesome. As always, Taylor Riggs. Looking forward to the close a little bit later. We're repricing the Bank of England once again. Hugh Pill, the chief economist of the Bank of England, the fiscal news requires a significant policy response. Guy Johnson and the team, they're going to pick up on that story in just a moment. Jim Bullard doing what Bullard does. He's sounding hawkish, saying the credibility of our inflation targeting regime is at risk. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
How much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, September 27th. Here are the top market stories we're following for you at this hour. Energy sabotage. You got leaks on the Nord Stream 1 have some pointing to sabotage. Europe now faces a winter without a large amount of Russian gas. We'll discuss with Bank of America's Francisco Blanche. And U.S. markets take a break here. You got the U.S. bond sell-off pausing, equity stabilizing, dollar falls from that record high. Europe, though, not so lucky. German 30-year yield topping 2% for the first time in 8 years. So is this the time to buy bonds? Jeffrey Goodluck is buying treasuries, and there is a lot of cash on the sidelines. We try and find out when to put it to work. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome everyone to Bloomberg Markets. Guy, yeah, we get this pause, but I feel like it's not going to take a lot for the sell-off that we've seen in the last couple of days to continue.
Well, if good news is bad news, then I think we've probably got some evidence to maybe push that theory along a little bit, Alex. Have you seen this data?
No, I was reading the prompter. Oh my goodness.
Quite strong.
Yeah.
And it's going to be, I'm hopping up and down because I'm kind of slightly in shock about how solid these numbers are. And this is only going to further encourage the Fed to need to take more dramatic action than it already the action that it already has.
So
do you want to run us through the new home sales?
Yeah, so what Guy's talking about is you get August new home sales month on month of 28%. That's enormous. I have to wonder if part of this is quickly let's close when we have mortgage rates climbing higher.
Yep.
I mean, 30-year fix is near 7% at this point. But that's a huge number.
The survey was negative 2.2. So that's a pretty solid number. The Richmond Fed Manufacturing Index has come through at 0. Now, last time around that was negative 8. The market was looking for negative 10. That's come through better than expected as well. Then you take a look at the Conference Board data. That's come through at 108. The market was looking for 104.6, was an improvement on the 103 that we got last time around. I just need to make this window a little bit bigger to see if we got any revisions. The prime number's been revised higher a little bit as well to 103.6. Present situations actually comes in a little bit better as well, 149.6. That's up from 145.4. Expectations also rises pretty strongly as well. These are strong numbers. This is strong data that we are seeing from the U.S. economy. The U.S. economy just feels like it's on a different planet right now to the rest of the world, and certainly feels like it's on a different planet, Alex, to where we are here in Europe and the UK.
Yeah, it definitely does. Interestingly enough, you are now seeing the long end, though, of the Treasury market sell off. We had seen some substantial buying come in. The front end is still catching a teeny tiny bit of a bid, but it seems like the data confirming the Fed's going to have to go harder and harder. But the idea is that at some point, the U.S. is the cleanest shirt in the laundry, and that there's nowhere else to put your cash at this point, or do you just sit in cash, in a pile of cash, and just wait?
Yeah. You guys are definitely the cleanest shirt in the laundry right now. Dana Peterson is the Conference Board's chief economist. She joins us now for some instant analysis on these numbers. Dana, I am quite surprised how strong the headline number is. Can you just walk me through your assessment of these numbers?
Sure, absolutely. Consumer confidence did tick up in September, and we think a lot of that's a reflection of three things. Number one, most people are still working. We've seen very strong job gains, and labor force participation among core workers, people aged 25 to 64, is rising. The second thing is that wages are rising almost across the board. So folks are quitting, they're finding better jobs and higher wages. And then the third thing is that inflation expectations have been cooling off a bit. And certainly that's a reflection of lower gasoline prices. So taking those things together, consumers are feeling a little bit better.
Is this a good news, bad news, though, situation? Like, this is exactly the scenario that you laid out, with the exception of inflation expectations rolling over that the Fed doesn't want to see.
Well, I don't think the Fed wants to see unhappy people, but certainly the Fed wants to bring down inflation. And when you look at inflation gauges, food prices are still rising, rents are through the roof, and costs for many services are also elevated. That has not improved, and so that's why we haven't seen a massive improvement in consumer confidence.
Well, just to pick up on Alex's point, though, Dana, the Fed has made it very clear that it is going to have to cause some pain in the labour market. What you're telling me at the moment is that that pain is yet to show up.
Yes, that's correct. I mean, our own forecasts, we have been saying for a while that we do expect a recession in the U.S. because the Fed is raising interest rates aggressively and to very elevated levels. That is going to cause some pain in the labor market, but we're probably not going to see 5, 6, 7, 8% unemployment. It's probably going to be closer to 4, 4.5%. And that's because of the massive labor shortages and the fact that we don't have a good supply of workers right now.
So is 4.5 to 5, which is what Charlie Evans also sort of intimated overnight, is that enough to bring inflation down to 2%? Or is inflation going to have to live somewhere around 3?
Well, our own forecasts have inflation kind of settling closer to 3% by the end of next year and not really getting to 2% until 2024. So I think the Fed really does need to bring interest rates to a very high level and keep them there in order to bring inflation down. But let's remember, inflation is being driven by supply and demand factors. The Fed can address the demand factors. They really need those supply factors to cooperate with what they're doing.
Dana, we are seeing a slowing housing market. I think that's fair to say, despite the fact we've just seen some cracking numbers coming through that Alex brought us. The housing market is starting to show the impact of higher mortgage rates. What is the relationship between higher mortgage rates and consumer confidence?
Sure. So certainly if you're looking to buy a house, it's going to make you feel a little bit sour, certainly. But we've already in the second quarter, we saw the housing market starting to slow as a reflection of very elevated prices, people getting priced out, but also because mortgage rates are rising because the Fed's raising interest rates. But that's all part of the plan. The Fed wants to cool off the entire economy by raising interest rates. So that's going to affect housing. It's going to affect cars, anything that people have to finance. And so this is all part of the program.
Mm-hmm. Right. How does that and when does that feed through then into consumer confidence? Because that's a huge marker for you. If you're feeling good, your house price is appreciating, you just feel richer. That's just the way that it kind of goes. So when do we see that?
Well, I think we're already seeing it certainly in the expectations measure. The expectations measure is still below 80. So anything below 80 historically tells us that consumers are expecting a recession. So even though right now in the moment they're feeling okay, they still think something negative, something bad is coming around the corner, and they're starting to feel, and so certainly as housing activity and home prices start to slide, that's going to affect confidence, we think, over the next few months. And that also is going to coincide with what we think will be a recessionary environment.
Dana, the data I'm seeing from the University of Michigan is a little bit more cautious. The consumer that they're talking to feels a little bit more nervous about the world. Can you explain the difference between what you're seeing and what they're seeing, if there is a difference at all?
Sure. I think the big difference is what we ask in our two surveys. Our headline survey does not ask about inflation, but we do ask about employment. And certainly, again, many people employed, labor market's doing great. So that's being reflected in our headline. Whereas with Michigan, their headline does include inflation. And so people are still feeling very bad about inflation. And so that's certainly more reflected in their number. But we ask about inflation separately in our inflation expectations gauge. While it has come off a bit, it's still very elevated, and people are thinking that inflation is going to remain elevated for some time, and that's a sentiment that the Fed wants to battle by addressing inflation now.
You also mentioned earlier that wages and jobs are also holding up relatively well. You mentioned that 4.5 to 5% U3 rate. Do you think it's possible that we get a job full type of slowdown / recession? Like, how does your forecast look from that lens?
Yes, absolutely. And we've been using that terminology as well, the job full recession, where you have negative GDP, and in particular, you have negative domestic demand with slides in consumer spending, housing investment, and business investment, and not much support from the government. But also not a material weakening in the labor market, where you see the unemployment rate rise anywhere from 4 to 4.5%. Some people are saying a little bit higher, but certainly not the leaps in unemployment that we saw during the pandemic or during the 2008-09 recession.
All right, Dana, thanks a lot. Oh, sorry, Guy, go ahead.
Sorry, no. I was going to ask, Dana, are you surprised by this data? Is this, would you have expected this data at this stage in a hiking cycle from the Federal Reserve and a slowing of the U.S. economy? Is it consistent with what you would have expected?
Well, yes, I do. Again, because when we think about the present situation, there's those three things that I mentioned at the top: jobs, wages, and lower gasoline prices. And for your everyday consumer, most people are driving, and if they see gas prices come off, that makes them feel better. But the expectations gauge is still telling us that consumers think something very bad is around the corner, and that's going to negatively affect them. And so I think that the data are telling us exactly what consumers are feeling, and it makes sense.
All right, Dana, look, we really appreciate it. Thanks a lot. Definitely seeing the market move on this data. Dana Peterson, the Conference Board Chief Economist. You have that long end sell-off picking up steam. You got yields really rising in the 10 and the 30-year. So coming up, our next guest is watching Nike this week. You got more on the consumer and some bearish calls from Goldman Sachs. Cameron Dawson, New Edge Wealth CIO, coming up next. This is Bloomberg.
I don't think they've been realistic about the pain that they're actually going to cause. If you look at their forecast last week, the unemployment rate climbs a little bit. It climbs up to 4.4%, and then inflation melts away. I don't think it's going to be quite so simple as that.
No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction?
Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
The Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
How much yields have moved up, especially real yields at this point, I think that was very tough to see. And I think this is what's making us so uncomfortable, because 150 basis points we haven't seen for a very long time. That changes the narrative from Tina, there is no alternative to Tara. There are reasonable alternatives. You can go to credit to get your nominal yield with relatively little risk. You can go to the tips market to get your real yield with relatively little risk. So your incentive to own equities is lower.
That was Christian Mueller-Glissman of Goldman Sachs speaking to Bloomberg's Francine Lacqua earlier today. So yeah, both Goldman Sachs and BlackRock turning more bearish on equities, warning that markets aren't yet pricing in the risk of a global recession. But that leads us to the question of the day. When do you get out of cash. There was $30 billion worth of money coming into cash last week in just 3 days. When do you get out of it? I want to ask Cameron Dawson, New Edge Wealth CIO. Cameron, your call.
Yeah, I think that, holding cash at much higher interest rates today is certainly becoming more attractive to investors, and that's why we've seen likely more pronounced selling within equities. And the question of when you get back in likely gets us back to this question of when we really start to see this earnings revision down cycle, because we still see earnings estimates remain very high. So it's hard to step into this market when we still see estimates for 2023 looking at 8% growth next year. Given the degree of tightening for the Fed, given the risk of recession, it's likely we still are in the midst of an earnings revision down cycle, which means that having more defensiveness in portfolios over the short term makes sense.
Cameron, a lot of people are holding cash because they don't know. They don't know what's going on. What's your degree of certainty right now as to what is happening in these markets and how the economy is unfolding?
Well, I think the one thing that is certain at this point is the near-term path of the Fed. And that's what's going to drive valuations, meaning that as the Fed continues to stay very hawkish and deliver on the tightening that it's promised, it's likely we continue to see this downward pressure on valuations and we stay in this high volatility environment. Now, what we've been telling clients is that as we get back to these June lows and as we start to test that 200-week moving average, which has been key support for this market really since coming out of the great financial crisis, that there is a high degree of uncertainty. And so if you are sitting on cash balances, now's the time to start thinking instead of tactically, instead of trying to buy the exact bottom and time it perfectly, start very disciplinary way of adding to positions, starting to add and kind of pick up some risk in a very controlled way, meaning buy quality names that have gone on sale. This doesn't mean put all the chips in all at once, but in order to keep us from getting emotional when things could get scarier as we go through this process, we think it's time to start thinking strategically and looking out 1-2+ years.
Okay, so break it down on where. So I'm looking at the price to earnings multiple for the S&P. For this year, estimated, we're looking at 16 times. For next year, we're looking at 15 times. So I'm wondering what that's accurately reflecting. And where do we see a significant price to earnings re-rating that you want to be buying those stocks?
Yeah, that 15 times likely isn't very accurate because it's based on earnings of about $243 a share, meaning 8% growth for next year. If you assume flat, the multiple is about 16 times. But then if you assume a 10% downgrade in earnings estimates, that gets you to 18.5 times on next year's earnings. And that would be far too expensive given the liquidity environment and given where real rates are. And we think real rates are really the key headwind for a big portion of this market, mostly in growth. At 1.5% on a real 10-year treasury, growth still trading at 22 times earnings is far too expensive, and that's likely where there's still valuation risk in this market.
What do you think the headline number should be? 12, 13, 14? Because if we're trading on those kinds of numbers, Cameron, this market has got a long way to go to the downside.
Yeah, we don't think that we need to get down into that 12 to 14 times earnings that we saw in market bottoms like in 08-09 when you were truly in a liquidity cascade, liquidity crisis. There's always times where you can test if you have a big selling moment, kind of that really capitulative flush where you might get down to those valuations over the short term. So this really takes out that scenario of another 20, 30% down that some of the biggest bears are calling for. We think that's something that's slightly below average, something that's closer to 15 times on real estimates, meaning that once we actually mark down valuations earnings estimates for next year, something closer in that 14, 50 times range seems more reasonable. And that sets you up for powerful forward returns from there, because not only do you have a low bar on the earnings front, but you also have valuations being below average, which are supportive of higher than average forward returns.
Capitulative flush does not sound very promising, Cameron. So where are you buying right now? Like, what are some of the stocks that you feel you can hide out in this flushing scenario?
Yeah, we're looking at across sectors and screening for quality factors, meaning we're looking for names that have very strong free cash flow generation, have light CapEx needs, that have the ability to return capital to shareholders, strong balance sheets. Because buying these names today is not about outperforming over the next 2-6 months, because what typically happens is those quality names actually lag in the initial rebound coming out of a bear market. But the reason we buy them is because they're trading at discounts to their longer run average. And we think that that's powerful because we're able to buy names cheaper that allow us to compound value through cycles, meaning that when we eventually go into the next downturn, these are the names that we're not going to have to sell. So for tax-sensitive investors, those that pay high capital gains taxes, buying names that you can hold through cycles and ride out the storm in is a really, really powerful thing to do during bear markets.
Cameron, it's great to catch you up as ever. Thank you very much indeed for your time today. Cameron Dawson, New Edge Wealth CIO. While we've been speaking, this news crossing a few moments ago, Wall Street is poised to settle the WhatsApp probe with a historic fine. We think that number could be around $2 billion. We're going to bring you the details next. This is Bloomberg.
Let's get back to that breaking news. Wall Street poised to settle a WhatsApp probe with an historic $2 billion fine. Bloomberg's Wall Street reporter Shania Bassick joins us now. So what was this about to begin with?
It's about using WhatsApp and other personal messaging devices outside of what is required of the banks, as regulators keep an eye very closely on how they communicate, where they communicate, and only through appropriate channels. So this really escalated during the COVID pandemic as many people were working from home and moving their communications onto WhatsApp, text messages, and Telegram rather than using corporate email or other approved ways of communicating. Now, what we're learning, the news here, remember a lot of the banks have already guided that they're putting away some money for these settlements. People familiar with the matter have guided that these fines could be similar to the size of JP Morgan, which are $200 million pretty much per bank. And what we're learning now is that this could come as soon as Wednesday, the results of the investigation from the SEC and CFTC, with total fines being about $2 billion The $200 million estimated per bank is much higher than what we've seen in the past. The last time such a lapse was really seen prior to what we saw at JP Morgan more recently was 2006, about a $15 million fine for Morgan Stanley for record-keeping lapses. So the size of these fines have really increased. And I think what's really important here is while these are dedicated to the banks and even European banks, which have created their own internal investigations, all of Wall Street is really starting to pay attention much more on how they communicate. And I think that's the critical difference here, Guy.
Sonali, is this provisioned for?
I missed what you had said, but...
is it provisioned for? Have the banks already basically set the money aside?
Yes.
Is this pretty much what it was expected?
It certainly is. And I think the big question here is, are there other things that they start to see bigger regulatory enforcement actions for? Again, this is much larger than we've seen for a fine of this type. And so when the Biden administration, when the Biden-era regulators do crack down on the banks, are these fines going to be larger for lapses in any other type of issue we see among regulators? I think that's a big question here. But to your point, Guy, a lot of this really has been siphoned off and really guided to investors that this would come.
I want to pivot here in just the last minute that we have also, because Jeffrey Gundlach was saying that he was buying treasuries finally for the first time in a long time because yields have risen so much. When you take a look at the hedge fund community right now and Wall Street, are we seeing yields now become more attractive, that it's an actual investment versus a hedge?
That's a million-dollar question. You have to take a look at the run-up we saw yesterday and what he's going to get from it at the end of the day. I think another big question for Jeffrey Gundlach is where on the curve. You saw a lot of his peers earlier this year start to get back into duration, but are they feeling the pain of that now? Are they seeing better opportunities now to buy in? Remember, they all really need this. If you take a look at a lot of these bonds, Jeffrey Gundlach's are down fairly meaningfully this year. Some of them are trading in the 76th percentile of their rival funds, some of them much less, some of them below 30%. So yes, is this a buying opportunity? We haven't seen one this good for a long time, but only time will tell whether this was the entry point.
Sonali, thanks for jumping in as ever. Great to see you on this story. Bloomberg Sonali Basak talking to us not only about Mr. Gundlach, but also what is happening with these WhatsApp fines. We'll get more details. Those will certainly follow. Pipeline sabotage. Germany blaming Russia for damaging the Nord Stream pipelines. Francisco Blanch is going to join us next. This is Bloomberg.
All right, we're about an hour into the U.S. trading session. You are looking at higher equity levels. We are off the highs, but we're also off the lows. Bloomberg's Abigail did a little tracking those moves. Abigail?
Yeah, Alex, it's interesting because yesterday, of course, you were calling it a dead cat bounce, a phrase I don't like because of my beloved cat. However, it's interesting. This feels more like a reprieve. You had a good call there yesterday, Alex, because it certainly didn't hold. We had another big down day. It's going to be interesting to see what happens here. And one tailwind for stocks is the fact that yields are in. You have that 2-year yield down about 5 basis points, giving a little bit of a break to stocks and other risk assets, and you have the dollar index down ever so slightly. Keep an eye on that dollar because if it does start to climb, then you could see a bit of a reversal. But right now, the bulls, the dip buyers, are trying to step in. This, of course, also as stocks, the S&P 500, right around those June low levels, so there could be some talk about whether or not this could be a bottom. As for what would perhaps create a bottom, it could be all about the dollar and yields. Take a look at the 2-year yield. This is really incredible. Over the last 2 weeks, backing up nearly 1%, backing up 85 basis points. Just a simply stunning move that I think that many people have never seen in their career, but it creates this huge repricing of risk right around for stocks, commodities, and on down the line. But because we have yields in just a little bit today, these are some of the sectors that are doing the best. Take a look at technology, software and services, autos and components, and then finally we also have the retailing sector higher off of the highs to Alex's points, but nonetheless higher. Not higher though, Guy, and this is really pretty stunning because Fed Chair Jay Powell did mention it last week on the press conference, the fact that get ready for a potential correction in housing. This is the Case-Shiller for the month of July, and we have the biggest deceleration price for the month of July on record ever. That includes the housing bubble back in the 2006 to 2009 time period. This could be an issue if this kind of deceleration continues, and of course existing home sales down, I think the last 7 or 8 months, down 25%. So yes, there could be some pain ahead for housing. It'll be interesting to see how that trickles through into the broader economy.
Absolutely. Abigail, thank you. I want to talk about another seismic event that we are watching very, very carefully, and that is what is happening with Nord Stream 1 and Nord Stream 2. These are the pictures that we are getting from the Danish Armed Forces. Just to give you a sense of scale of what we're talking about here, I don't know if you can quite see it, but this inner ring here, and these are bubbles coming to the surface. This is natural gas coming to the surface after we've had 3 leaks, two in Nord Stream 1 and one in Nord Stream 2. This is what is happening in the Baltic Sea right now. I don't know if you can see it up here in the corner. These are huge gas bubbles that are coming to the surface in the Baltic Sea. The Germans are talking about this being a deliberate action. To give you a sense of the scale of those pictures, the inner circle was 200 meters wide. This was picked up as a seismic event, basically, in the Baltic Sea. So what you've got here, and this is basically the map of Nord Stream 1 and Nord Stream 2 going through the Baltic Sea from Russia into Germany. You've got 2 problems in Nord Stream 1 and 1 problem in Nord Stream 2. The fact that they've happened at the same time within a 24-hour period in such a close area is leading a lot of people to conclude that what we're looking at here is some sort of, people are describing this as potentially enemy action. It may not come as a surprise to many. This is an issue that has been huge and concerning for the LNG market, for the natural gas market for quite some time. The ultimate shutting down of Nord Stream 1 and Nord Stream 2. Let's talk about the impact that this could have. Francisco Blanch, Bank of America, Global Research Head of Global Commodities and Derivatives Research, joining me now on set here in London. Nice to see you in London. The pictures are epic. The pictures are substantial, but in some ways not surprising.
Yep.
We've been waiting for the moment when natural gas out of Russia ultimately gets cut off. And I guess that probably is a clear indication that this is now happening.
Well, I mean, Nord Stream 1 has been shut down for a bit, but I think and clearly what we are seeing today is that the pipeline is going to be off for a pretty extended period, right? So the market has to reprice that, and we're going to see likely upside pressure on longer dated natural gas prices in Europe, TTF, which is the benchmark for the region. And in fact, Guy, we've seen that for quite some time already, because the market is realizing that the Russia-Ukraine conflict is not going away tomorrow. So we've seen enormous amount of pressure on longer dated 2023 and also winter 23-24 prices on TTF in the past month and a half or so. That's where all the actions have been happening, even though the front end has come down because we filled up inventories ahead of winter. So that's really a big story. And frankly, we are now walking into potentially even tighter markets if the U.S. and Europe collaborate to put a Russian oil price cap, which may reduce volumes on the crude side,
Hey,
which
Francisco,
until now have been quite healthy.
Francisco, before we get to oil for a second, I'm looking at the TTF 1 month forward curve right now on the terminal, and the gap between where we were a month ago and where we are now is pretty significant. I mean, a month ago, if you take a look at, say, July 24 prices, we were almost to 300. Now we're down to about 150. How much repricing do you think we have to see for 2023, 2024?
Right. So Alex, I think you've kind of hit the nail on the head here. We've seen the front month contracts coming down, but the longer dated ones have actually moved up. If you look at the 1 year out, we've more than doubled in the past couple of months. And what the market's kind of assessing is, well, throughout 2022, we've actually had a lot of Russian gas coming through until Nord Stream 1 was shut down in June. So we've had 6 months of Russian supply that have helped build those inventories. Now we have to do the same thing again in 2023 without those Russian volumes. That is the main concern that we all have for European energy in the year ahead.
How much demand destruction does Europe need to see with current gas in storage and expected supply to get through this winter?
Well, so I think we're all going to have to turn our thermostats down. We've heard that from authorities all over Europe. That's going to be one element. We're also seeing factories in Europe shutting down. So we've seen steel production, aluminum production, fertilizer, methanol, even refining capacity in Europe. Really a whole lot. Anything that uses energy is being curtailed and is being imported. And then just generally, we're seeing also some factories essentially potentially being curtailed into the winter. So it's going to be tough, but the real answer, it depends on the weather. We have to, in some way, as I like to say, pay and pray. We have to pay up a lot of money to keep European gas flowing in from Asia, displacing essentially gas burn in Japan and China and Korea to be able to bring it to Europe, but also in Bangladesh and Pakistan and Brazil. So that gas needs to come here. And then the second thing that needs to happen is we need to pray for milder weather into the winter, because a synchronous cold winter across Europe, Asia, maybe US would be very catastrophic for energy markets.
Francisco, we have seen a lot of gas to oil switching, as oil in essence is cheaper than gas, in addition to other switching as well. But then we get this report that potentially Russia is looking to propose that OPEC Plus cut 1 million barrels of oil a day from production. No surprise, that's coming on a day like today.
Right.
A, do you think that happens? B, what's the ramification of that?
So, look, I mean, OPEC is meeting up next week. We've picked up 2 data points in the past month or so that are very important when it comes to finding a floor for oil prices and for energy generally. One is coming from OPEC. OPEC last month didn't implement a big cut. They delivered a token cut, but nonetheless a significant cut, because OPEC had never cut production before over $90 a barrel. So that's the first signal. And I think Prince Abdulaziz and the rest of OPEC were very clear that if prices keep coming down, they're going to take production away from the market. And then the second element we talked about in our research, which is why we said 80 is the new 60 for oil, meaning that we have a higher so-called put on oil prices, is coming from the US SPR. We've emptied out strategic storage, and we're going to continue to empty it out through October. So really, we need to refill that government strategic stockpile in the year ahead, and that's about 500,000 barrels a day of incremental demand on that element.
Why do we need to refill it? What's the purpose of refilling it?
Well, the purpose of refilling it, guys, is essentially to be able to weather the next shock, right? I mean, we want to have some levers to be able to tame down potential upside pressures or war events, or essentially anything that gets thrown into the Western world. But that is a good question. Why we could let the market do the work?
The US is energy independent. It produces a lot of oil.
It does, indeed. But in some ways, I think the political, the government in the US will lose a lever it has to essentially tame down oil prices. So it is true that you may not have to refill it as such, because you don't have, as you said, I mean, the agreement on the IEA is to have 90 days of forward supply, forward imports in storage, right? So in the US, you don't need that level of storage anymore. But at the same time, you're being left exposed in a very volatile world where geopolitics are really driving activity. You're exposing yourself to a potential shock, and I think that'd be that'd be worth something, looking into and refilling the SPR for that reason alone.
Well, aside from that, though, I wonder if it's also on the U.S. side a signal to oil producers that we might not support you in other ways, but in essence, we're going to provide some kind of floor to try and give you a longer-term incentive to keep producing oil. Is there anything to that, and are oil producers paying attention in that way?
I mean, there's certainly something to that, but I do think the U.S., if you take a look at the next 3, 5, 7 years, what's likely going to happen in the U.S. is the U.S. is going to become a bigger and bigger exporter of energy to the planet, simply because Russia and Putin have thrown the keys of the energy market to America and said, hey, take over this, right? The U.S. is going to be exporting a lot more LNG into Europe and into the rest of the world, but also a lot more oil and petroleum products. Because what's happening in America is you're going to have a big green energy revolution with the Inflation Reduction Act, which will quickly curtail emissions and therefore free up a lot of thermal fuels for export. And so that's how I think things will play out for the U.S. It's going to be an interesting decade ahead.
You worried about Ian?
I worry about
Ian, the hurricane.
Oh, the hurricane.
I can't believe I got to ask that question.
Yes, I do worry about Ian, the hurricane. It's it's not impacting critical infrastructure yet in terms of the path that we're seeing, but it's always, I mean, hurricane season is always a concern, although we're getting to the tail of it, so we have another month or so. I mean, I think all eyes on the energy markets are really set on December, January, February. Those are the months that we are focused on more than the tail end of the hurricane season.
What's in the path, though, Francisco? I feel like we usually talk about, of course, the oil rigs and then refiners, et cetera, but I also feel like fertilizer plants could get hit really hard, and that's already been in short supply because of the natural gas shortage, et cetera. Like, what are you looking at most as we really pick up into this hurricane season?
Look, I think when you think about the key drivers of what's happening on a global basis, is we are seeing the replacement of supply of key energy-intensive commodities in Europe, like fertilizers, for production elsewhere. So obviously, we're seeing more production in the U.S. Gulf Coast, more production in the Persian Gulf, in the Middle East, and any impact that any climate activities may have on those regions of the world could obviously alter the ability of Europe to fill that gap. Because ultimately that's what this is about. It's about filling the enormous gap, the enormous void left in Europe by Russian energy, which in the case of natural gas alone is about 10% of European supplies, or about 3 million barrels a day of oil equivalent. So all of that's being readdressed across the global supply chains for energy, but also across the entire commodity world. We are seeing a big reshuffling of activity being pushed out elsewhere.
All right, Francisco, it's always good to get your perspective. Perfect day for it also. Francisco Blanch, Bank of America, Global Research, Head of Global Commodities and Derivatives Research. Thank you so very much. Well, coming up, continuing the conversation with Ian here, making landfall over western Cuba as a major Category 3 hurricane. It is turning towards Florida and what could be the worst storm to hit Tampa in over a century. We're going to look at the potential damage with Chuck Watson, disaster modeling specialist at NQ Research. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. A NASA spacecraft has successfully crashed into an asteroid about 6.8 million miles from Earth. It was a test to determine if the impact can nudge the space rock slightly off course. The U.S. Space Agency is in the early stages of a plan to protect the Earth from asteroids. If measurements show the asteroid's course was even slightly altered, NASA will consider the mission a success. Hurricane Ian has now turned into a powerful Category 3 storm as it takes aim at Florida. Ian made landfall in Cuba early today. It's now on track to become the worst storm to hit Tampa in more than a century. Hurricane conditions could arrive in Florida Wednesday morning with winds of up to 140 miles an hour. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's get more on the hurricane here. We're joined by Chuck Watson, NQ Research founder and director of research and development. He's the guy you go to model certain disasters all across the board. In particular, hurricane season is one of his busiest seasons. Chuck, first off, I guess the best question is, do we understand maybe the path yet to understand what kind of damage number we're looking at?
There's still a little bit of uncertainty with this, Alex. It looks like, we were worried most about Tampa, but the focus is actually shifting a little bit south. I expect the new Hurricane Center forecast that should come out here in about 10 or 15 minutes will probably shift it even further, more towards Sarasota, Port Charlotte, that area. Now that still means that the Tampa area is going to be on the fringes, but the big fear of punching a big storm surge up Tampa Bay, at least that's a little bit less. The problem is on this track, it's looking to go right up through some of the big citrus producing areas. There's phosphate mining and facilities in the way. Then of course you've got, as a decaying storm, crossing Disney, Orlando, up through the I-4 corridor. That's still, you're looking at, I think the lowest we're going to see is 30 billion in economic impacts. And if it stays stronger inland, we could hit 60.
Okay, wow. Chuck, good morning, it's Guy. We just had a graphic up that said this could be one of the worst storms to hit the region in over a century. Can you just give me a sort of sense from your perspective of the scale that we're looking at here?
Yeah, the last big storm to hit the Tampa area was 1921, so just over 100 years. And of course, there was nothing down there at that point. Now, the way the track is shifting now, it's actually, we've got a more recent example, and that's Hurricane Charlie in 2004. And so that caused, if you account for 15 years worth of growth, the equivalent of about a $20 or $25 billion storm. So we're kind of in that realm. It's definitely going to be one of the stronger storms and more damaging storms. And in particular, given the economics right now, probably one of the more impactful from a wider national standpoint.
So, Chuck, you mentioned the industries that are going to get hit, and I feel like this time is different. We're in a very different world right now because of the increase in natural gas and oil prices that have really shut in certain areas of industry. So I'm wondering if you anticipate the phosphate industry, for example, to have a different kind of reaction than they would have, say, even a few years ago.
Yeah, absolutely. At least the positive side on this is that all of the effects are going to be well south of the major oil and gas fields. So there are some scattered shut-ins and there's precautionary measures, but mainly for waves propagating up. But the infrastructure should be able to handle this. There shouldn't be anything more than a brief transient impact on at least natural gas production and refining in the U.S. Now the problem is this is trucking right across. You look at the phosphate areas. The Mosaic Company, for instance, has a lot of facilities that are in the direct path. Those are going to be offline for 3 to 6 weeks because of damage and disruption from the storm. Again, if you look at things like, from a consumer standpoint, citrus, something like 2/3 of Florida's citrus production is going to be within the tropical storm force wind swath, and it's nearing harvest. So all that fruit's probably going to be lost. A bigger concern is if the storm keeps its intensity inland, you're not just looking at losing this year's crop, you're looking at tree damage. That can take 4 or 5 years to recover.
Chuck, as it makes its way up into sort of onto land and then further north, how quickly does it dissipate? How much damage is it going to cause? How much further will we see the effects of this storm being felt?
Well, I can give you an example of that. In 2004, I do work with the University of Central Florida, and I'm a private pilot, flew down there. It was a sea, literally a sea of blue tarps all across Central Florida from Hurricane Charlie. And so you're likely to see damage all the way up to the Jacksonville area. Of course, you think of the big tourist industries in the Orlando area, Disney, Universal. You look at all of the economic activity that surrounds that. Even, of course, the Artemis spacecraft had to be rolled back to the vehicle assembly building. You're looking at disruptions all the way across the state. That I-4 corridor is so important to Florida's economy. And with a storm like this, you're looking at maybe, again, 3 to 6 weeks of disruption, even if it decays to being minimal hurricane or tropical storm by the time it gets to Jacksonville.
Oh.
Batten down the hatches. Chuck, thank you very much indeed. Chuck Watson of Enki Research. Greatly appreciate your time updating us on what is happening with the track that we're now looking at for Hurricane Ian. The producer's telling me I'm mispronouncing that word, apparently.
You talk funny, man.
Maybe it's just, it's a car. Maybe I'm just thinking about that. Let's talk a little bit about what is happening with Italy. Talking of cars, St. Agatha, to the wider economy. Italy, this is a Bloomberg story. Italy has sourced sufficient alternative supplies of gas from North Africa to make up for any shortfall this winter if Russia would immediately cut off all exports to the country. This obviously, Alex, on the day that we've seen these explosions, let's call them that, for Nord Stream 1 and Nord Stream 2.
And that's sort of the point, I think, is that there is the potential for Europe to actually have enough gas to get through the winter, but then it's how much you dipped into storage to get through it, and then how quickly you can rebuild it. Bloomberg New Energy...
And how much you pay for it.
And how much you pay for it. Well, exactly. And then what it does to consumers. Bloomberg New Energy Finance says that, look, that buying, along with demand destruction, even if flows go from zero starting October 1st from Russia, you guys will be good. But to your point, at what price?
At what price? And are you going to get the demand destruction? Because at the moment, governments are incentivizing people maybe not to deliver that demand destruction. That's obviously the concern here in the UK as well.
Yes, and if you don't do that, then you're just putting off that moment of reckoning further out into the future.
Absolutely. But as ever, Alex, it comes down to the weather. We need to talk about the weather. We've just talked about your weather. We can talk about our weather as well. This is Bloomberg. The pound bouncing back today, but not by much. in the big scheme of things, it's still a substantial bounce. We're up by 0.7%. We're not getting that bounce in the bond market. We are seeing yields continue to lift. We saw those comments from Hugh Pill, the chief economist at the Bank of England, certainly furthering that. Stocks are generally a little bit higher. We're up by 0.6%. Charlie Bean is going to be joining us, former chief economist over at the Bank of England, professor now at the London School of Economics. He's going to be up with us in a few minutes' time. This is Bloomberg. Tuesday, September the 27th, European stocks are bid, but the focus remains firmly on foreign exchange and the bond market. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So the scale of the bounce back we're seeing today in sterling is in some ways impressive. But once you take a step back and think about the turbulence over the last few days, it is understandable and maybe a bit more diminutive. We're trading at 107.74, but the real action maybe is over here in what is happening in the bond market. The gilt market, I think, is a very confusing place right now, and the shape of the curve, I think, is equally confusing. We have seen we have seen Hugh Pill. Charlie Bean will be joining us shortly. We have seen Hugh Pill out today with a statement which was more hawkish than the statement we got last night from the governor. He certainly talks about a response to the fiscal package that we got last week as being required, and to be sizable. The market has, as a result of which, priced even more aggressive hiking from the Bank of England as a result of what Mr. Pearl has been saying. So the 5-year yield is doing that. Stocks in some ways continue to be the kind of the afterthought a little bit here. We're trading up off our recent lows. We're trading 391, but we're still down near to the lows for the year. Today, we're up by 0.7%, Alex.
Guy, here it feels like the U.S. is trading in a little different pathway. We did see a rally underway. Then we got the consumer confidence numbers and new home sales month on month. Both of them were really good, really killer numbers out there. You saw equities sort of come off the highs of the session, then off the lows, and now we're kind of bouncing around somewhere in the middle. The S&P up 1%, the NASDAQ 100 up 1.4. Maybe this is really the dead cat bounce that I was looking for yesterday, but we did fade that move yesterday, so watch into the close. I wanted to highlight the 2 and the 10-year because at one point they were moving in opposite directions. So you saw pretty steady buying all morning long into the 2-year. You have yields down 4 basis points. You have seen solid buying in the back end. Then you got those really good numbers, and that means the Fed's going to have to do more because the data is holding up a lot better than maybe anyone had expected. And then all of a sudden you wind up seeing a little bit of selling, but now we're pretty much flat. And it does seem to feel, the more the story continues, Guy, that the 2 sets on either side of the Atlantic are starting to really move in opposite directions to some extent.
Your economy feels very different to our economy right now. Very different, completely different place. And that comes on a number of fronts. At the center of it in some ways is the energy security that you guys enjoy. And that is certainly not something that we are able to enjoy over here in Europe. The pictures that we've been getting today from the Danish armed forces of the leaks in the Baltic Sea. This is Nord Stream 1 and 2, the leaks. These are pictures that we've got. The center, the middle of that bit there, the middle of those pictures there, that's about 200 meters wide. Shipping is being told to avoid it. There is effectively an exclusion zone around these leaks. This is natural gas, highly flammable natural gas that is bubbling to the surface after we saw 2 leaks in Nord Stream 1 and 1 leak in Nord Stream 2. Absolutely unbelievable pictures you can see there. Rachel Morrison, who leads our power, gas and renewables coverage in Europe, joins us now for more comments on this. Let's talk a little bit, Rachel, about the impact that this will have. The pictures are dramatic. Is the impact going to be dramatic?
Yes, I mean, we have no idea how much gas is leaking. I mean, we've understood that the pressure started to drop on the pipeline very quickly. So although neither Nord Stream 1 nor Nord Stream 2 were operational, there's gas still sitting in the pipeline, and a leak meant that gas started to escape very, very quickly and the pressure dropped. And as you can see, it is huge. And I mean, that's methane, so not only the kind of explosive and flammable quality that you mentioned, but also the environmental impact that could have as all of this methane just seeps out into the environment. So the European Commission has asked member states to, look into what the climate impact of this could be, because not only just on the gas market, but also the environment, this impact could be big.
Huge. We saw Denmark, Rachel, putting their energy infrastructure on high alert. And I wonder what you're hearing about potential other attacks. I was reading about potential cyber attacks, sabotage in other areas. Do you have a sense of what Europe is starting to prepare for?
Yes, I mean, it has emerged throughout the day that several nations are now convinced that this is a sabotage. So that will put everybody on high alert. And can you hear me?
Yep, we got you. Keep on.
So yes, we know that several nations are on high alert about other infrastructure because we think that possibly this has been carried out by Russia, and that is going to be very unsettling across Europe because we don't know what will happen next.
Rachel, apologies for the confusion. Thank you very much indeed for bearing with us. Bloomberg's Rachel Morrison talking about what is happening to Europe's energy infrastructure right now. The pictures are unbelievable, but it speaks to a wider problem that the European economy now faces, a problem that maybe is not represented over in the United States. How much of this is actually priced in to European assets? particularly the credit market, which I think is a really interesting place to be looking at where the risk for this could ultimately, again, bubble up. Madeline Jones, Oaktree Capital Portfolio Manager for European Credit, joining us now to try and help answer that question. Very nice to see you in the studio.
Thank you.
Europe has a major energy problem. The picture